Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Standard Chartered Money Insights. My name is Iachini, and I'm a cross-asset strategist from the CIO team. On today's episode of the podcast, we'll discuss what to expect from the upcoming week, where to a strong degree the Fed will be expected to announce its tapering plans, and during which we'll also see Germans go to the polls for their federal election. Joining me today for this conversation, I'm glad to welcome back Manpreet Gill, head of fixed income, currencies, and commodities. Without further ado, let's start today's conversation. It is going to be an eventful week for investors. As I mentioned in the intro, first comes the 22nd September FOMC policy meeting, and then the German federal election on the 26th. Manpreet, what are some of the factors you think investors need to watch closely?
Hi, Marco. Indeed, it's shaping up to be quite an eventful week ahead. And there are, like you said, I think the Fed and the German elections are two events we're quite focused on. Maybe starting with the Fed first, I think there are two areas that we'd sort of have a specific focus on from a market perspective. First, like you mentioned, it's about tapering. Specifically the timing of the start of any taper, and of course the pace at which the tapering of those bond purchases occur. But arguably, from a market perspective, we're less concerned about what impact that might have. I mean, tapering has now been discussed to quite a level of detail over the past few weeks, and unless we get a significant surprise from consensus expectations, the market impact is likely to be quite low. Instead, we think the focus should be on implications on the path of future interest rate hikes, and that might seem quite far away. I mean, markets are currently looking for the first rate hike only in 2023, but together with the implication from memory taper timing, but also from any updated dot plot, if we see any shifts in those future rate hike timing, whether the timing that first rate hike is brought forward to the tail end of 2022, or if there's a shift in the expected pace going into 2024, we think that could have more of an impact on financial markets through the channel of bond yields. So that's something it's something we'd keep quite a tight focus on, because we think the implication of markets are more significant there, particularly when positioning in U.S. Treasury bond yields is quite one-sided at the moment in favor of a dovish view on yields. So that's on the Fed. German elections, like you said, of course, the other key event for next week, which is scheduled for next weekend. There are many potential combinations out there from a coalition perspective, but for markets, I think the key is the implication for fiscal policy. I think most combinations are likely to be positive fiscal policy. It's really a matter of degree depending on the political coalition. So that's what we are focused out of the elections, and we think the greater the fiscal stimulus, the more positive the outcome, not only for European assets, but the euro currency as well.
Okay, and so how should investors, equity or bond investors, position to take advantage or perhaps hedge such catalysts in this week?
Well, for us, the common thread really is U.S. Treasury yields. So, like I discussed, that's where we may get a trigger from the Fed that starts a renewed grind higher in 10-year bond yields. I mean, recall that on a 12-month horizon, we do expect 10-year yields to be modestly higher, and the implication a little bit different for equity and bond markets. I think from equities, recall that higher bond yields are consistent with value style equity outperformance. So that's something which could resume should we get treasury yields being triggered higher after the Fed, regardless of whether there's some tapering, of course, or from interest rate expectations. And you can implement that in a couple of ways. I mean, from a sector perspective, a lot of our preferred sectors like financials and energy should benefit from a value style outperformance, but equally from a country perspective, where regions like Europe or the UK do have quite a heavy tilt towards value style sectors. So for equity markets, we think that may be the most interesting implication, particularly from the Fed. From the bond market perspective, we think it's about limiting bond yield sensitivity to rising bond yields. So of our three preferred bond asset classes, Asia dollar bonds and US and European high yield bonds, both of those tend to be relatively less sensitive to shifts in treasury bond yields, and more so to developments in the credit quality of the underlying assets. So those are the two out of our three preferred assets that we have a disproportionate focus on. Of course, valuations are if anything, more important, given the focus on credit. And look, admittedly, in the US and Europe, particularly in the US, valuations based on credit spreads are not cheap. But actually, when you look back through history, that's not unusual. And US high yield spreads can become increasingly expensive going right through to the end of the cycle, as long as there isn't a significant surprise from a credit perspective. So that's, we think, a mitigant. Asia, of course, at the opposite end of the spectrum, where concerns in Asian high yield, particularly in the property sector, have led credit spread based valuations to blow out and become quite inexpensive. But again, not to downplay the concerns, but given where prices are today, a pretty high chance of default seems to already be in the price. So unless we get a significant surprise in the form of a disorderly default, we do believe that current valuations offer an attractive entry point.
Thank you, Manpreet. That was quite a comprehensive overview. Now, last, to finish off the podcast, after an unusual lull in August, oil price jumped due to climate events, but at the same time as inventories continued to dip. Where do you see the oil price rally going forward?
We're still modestly constructive on oil prices. So, like you said, I think the recent rally in over the past couple of weeks has been driven by not only the dip in inventories, but we also saw OPEC upgrade its oil demand forecasts, with most of the upgrade being driven by Chinese demand in particular, which is not surprising given our view that the economic recovery is likely to extend. So, from a demand perspective, that's positive. But we think there are a couple of factors why this constructive outlook could extend. I mean, one is, if anything, we think that demand outlook could improve. But second is, particularly going into the winter, we're seeing pressure on many other traditional energy sources like natural gas. So the substitution effect could provide a boost, from a seasonal perspective as well. Now, having said that, we do believe there is a bit of a supply cap on oil prices. So when you think about whether it's OPEC supply or of course, U.S. Shale oil supply, as prices rise, we do think supply will also respond to catch up. So again, outside of short-lived spikes, we still expect WTI oil prices to be contained, just below $80 when you're looking out over a 6 to 12-month horizon. So a constructive outlook, albeit a relatively modest one.
Fantastic. Well, thanks again, Manpreet, for joining our conversation today. That is all for this episode of Standard Chartered Money Insights. If you would like to learn more or read our publications, please visit our website at sc.com under Latest Market Insights. As a reminder, if you enjoyed our discussion, please rate and review us wherever you get your podcast. Thanks for joining us.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.